We had the great crash and recession of 2008 into 2009, and the central banks just went haywire. I mean, they just started printing tons of money. They didn't let that recession do its work, okay, and work out the excesses and the zombie companies and the bad debts. So we're carrying all this into the future with endless stimulus, and then COVID hits and they go haywire even more. $10 trillion, Dan, fiscal and monetary combined, about half and half. $10 trillion in 2 years.
Hey guys, welcome back to Library of Wealth. Today we have Harry Dent on the coming economic depression and how that will affect all markets this year. Dent says that we will have 3 waves of a market crash, the first being the post-crash bounce. This means that people are starting to believe everything is over now, but we're actually still in a recession. Dent says the recession actually began back in 2009, which was surprisingly more of a depressionary period. He says that a bubble of that size should have created much deeper and longer consequences, but notes that even with stimulus, the Fed overreacted about the economic shutdown, which was a massive mistake, and forced them to tighten. Let's listen to this interview with Harry Dent as he forecasts the downfall of the financial market and the economy. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
What people don't realize, they've been keeping this economy going now for 13 years purely on stimulus. Because the baby boomers are done, and the millennials, which I project very clearly in the future, a boom for like maybe late 2024 into 37. Okay, but in between we've got this weak fundamental economy driven by stimulus, and now they've gone so far they have to tighten and work against themselves. And I think this tightening is not going to be taken well by the economy. And by early next year, we're going to see another wave of stocks down, just like we saw or more. I call it the first wave crash. We're in that rebounce, and we're just coming into the third wave now. We're just making new lows and a lot of stuff, so that's a bad sign. I think we have another big wave down into late this year, early next year, bounce, and then we have another big wave down into late next year, early 2024. This will be, what I've been saying, the crash of our lifetime. It won't be quite 29 to 32, but it'll be more like 29 to 32 than it was 74 to 75 or 2000 to 2002. And it'll be like, I call it 2008 downturn and recession times 1.5. That's my rule. This is going to be 50% worse. Whatever you thought 2008 and 9 was for your business or investments, this should be about 50% worse, which means get out of the way, especially in investments. In a major bull or bear market, in other words, the direction you're going, and now we're in a bear market from my point of view. So the waves ought to be 5 waves up in a bull market, as we saw 87, 2000, 2000, that sort of thing, 2021. Now we're in a 5-wave sequence down. We saw the first wave bottom in June, okay? We've bounced since then, and now we're coming out of that bounce. We're in the third wave from my point of view, just breaking below the first wave in the NASDAQ and most of the major indices in the S&P. And this third wave should be at least as strong as the first one, and it should be stronger. It's likely to be 50 to 60% worse. So we could see the worst of this downturn into early next year. It took 5.5 months, that first wave, so it's probably going to take that or more for this one. First wave took down the NASDAQ 34%. This will probably take it down, after a bounce down 55 to 60. Now that Dan is when people are going to know, this is no longer a correction. The central banks actually lost control.
Dent believes that we're currently in the weakest part of the biggest demographic downturn in financial history. He says that this downturn must eliminate all major debts in the system, but the economy will never be able to clear out the overflow of overvalued financial assets. He says that to return from this, all assets need to deflate back to normal. People need to grasp that this is the largest financial asset bubble ever.
See, all I've been waiting on, Dan, for years is the central banks to lose control, because all they've been doing is printing money. You don't solve any real problems with short-term cures like just printing money out of thin air. You have to restructure, you got to cut back debts, you have to do real things businesses would do in a turnaround. And now it gets to the point where they overdid it. I think they have lost control. There's no way for the Fed. They can't turn around now and loosen aggressively after finally admit they have to tighten, and after they responded. They're stuck. By time they do turn around, this crash is going to go down enough that people will say, no, We thought that the central banks could control this. We thought the economy keep going up. People are going to get scared, and then you can't turn them around. There is nothing, including the magical gold, that did not bubble. In fact, gold at the peak of its bubble not too long ago went up more than stocks did. So people saying buy gold is the same. That's one of the biggest bubbles. Okay, so everything, financial assets have to reset. And then I'll give you the most important number in the world, Dan. $577 trillion going on, probably closer to 600 by now. That's all the financial assets in the world. And that normally is 2, at most 3 times GDP. It's like 6.5 times global GDP at 94 trillion. So this is a global bubble in everything. Real estate, it already went down 34%. We didn't even see that in the Great Depression because we didn't have a real estate bubble in Roaring 20s. You couldn't borrow money easy enough to have a bubble in real estate. It was crazy. Now we do have a global everything real estate everywhere. So I'm seeing real estate going down, what did I say, 1.5, 50% instead of 34%. Now that is painful. It's one thing stocks go down, stocks can bounce back pretty quickly. And most people don't have most of their net worth in stock. Most people do have the majority or a big part of their net worth in their home.
It's all real estate.
People have vacation homes, and a lot of people have been speculating in real estate. This real estate crash, if it's 50%, and that's just going back to the 2012 lows. It's not going that far in history. We're not going back to 82 or 90 recession or anything. Just down to the recent lows. We came out of 2008-9, but real estate took much longer to turn around. We didn't come out of real estate till 2012. We're going to just go back to those lows. That's 50%. That's how big a real estate bubble. Real estate doubled since then. So that's going to be the most painful thing for most people. Their house goes down, and this time it doesn't go roaring back up. We had a bigger stock bubble than anybody, but real estate bubbled everywhere. Australia and New Zealand have an unbelievable real estate bubble, and the #1 real estate bubble in the world is China. China's stock market, okay, yeah, but everybody owns homes. Poor people own sometimes 2 or 3 homes, and 1 or 2 of them sitting empty in China. So China is going to get hit the hardest by this, Australia by being next to them. The whole world's baby boom is turning down, except for Australia, New Zealand, and Norway and Sweden, a few small countries. So this is a back to reality now that the baby boom and all the stimulus has gone as far. We go back down to reality, and that just means stocks go back down to early 2009 lows, real estate 2011, 2012 lows. And people say, well, that's no big deal. No.
It is a big deal. Yeah, you're talking about the big short on steroids.
The S&P, 92% the NASDAQ, and 50% in average real estate, 60 to 70% in upscale ritzy real estate. So this is going to be the biggest shock we have seen in our lifetimes. Again, more like the early 30s, maybe not quite extreme. That was just a naked crash. They didn't do anything to stop it. No stimulus, anything, no cushioning. And it'll be the biggest. Our kids will not see a crash this big, I think, even when they grow up. Central banks, after more and more stimulus, for this thing to fall apart just 2 years after 10 trillion, by the way, is 46% of GDP. You imagine explaining to your grandkids, well, our central bankers thought we should spend 46% of our GDP just to keep a tired boom going another couple years. How does that sound, kids?
Dent says that inflation is the only thing that has dramatically increased in the current economy. The Fed mistakenly believed they could produce more money without creating any inflation. The only reason inflation didn't happen was that demographics were slowing and the economy was extremely weak. Dent strongly believes that the housing market is the worst economy because it's already decreased by 34%. Housing has already had a gigantic crash, but we've been pushed through. Dent firmly believes that the next crash will cause many who are paying a mortgage to go bankrupt immediately. What do you guys think about Harry Dent's opinion on the economic crash and the failing housing market? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.